for those that invest in private companies, should that company in, I don't know, a X amount of years become public, I'm assuming there will be benefits for those that got into these companies quite earlier on.
Yes, huge benefits. So it is common that most people may have been even private asset investors without even knowing.
Hello and welcome to the Woke Finance Podcast, a podcast discussing all things finance and all things finance related. It's your boy Peter, and I'm with my co-host, my bro Jax. How are you today?
Yes, Peter, I'm doing very well. It's been a while since we put out an episode, and since then, the stock market has been on an absolute tear, up, absolute upwards trend, which means Jax is happy. It's good to see my wealth go up whilst I sit back and just watch it go up. So I'm doing very well, Peter. How you doing?
I love that. I'm good. I'm good. I'm good. I was gonna ask and say and clarify that's not the reason why we've been away. We haven't been celebrating or anything like that because that's not what investing's about when you
No.
see something go up, right?
No, absolutely not. The truth of the matter is, bit of a news for some of our listeners. If you are a long-term listener, you've probably heard me say it before, but I personally have undergone a huge career change slash sabbatical. So yes, I've been on a bit of a holiday mode. I've just celebrated my 35th birthday, which is absolutely amazing. I was away with my wife. We were over at Morocco. We stayed in a very popular place called Marrakesh and another place which I cannot remember because usually it's my wife that sets up everything. I just turn up. So that's why we've been away. I've been celebrating my birthday, but yes, the stock market has been going up and it has its pros and cons. Don't take my word for it. We're not too excited that it's gone up because we are long-term investors.
That's it. That's it. That's it. Shout out to you as well. And yeah, thanks for sharing about the new season you're in. And of course, massive birthday month to you as well. And to our listeners all over the world, man, we recognize you. We appreciate you for your ongoing support. So, we're gonna kick off this episode talking a bit about over the years, we've spoken about a number of different types of assets that people should probably learn a bit more about. Whether they want to invest in those assets is, of course, up to them. But, having knowledge around different types of assets is also a good thing. And one of the things we're going to be talking about today, Jax, which we haven't really spoken about much, is private assets and more or less how can the everyday individual retail investors invest in private assets. So, without obviously further ado, I am going to have to ask the obvious question, Jax, and that is, what are private assets?
Yeah, great question because it's not so obvious. And probably the best way to answer the question is to start off with what private assets are not. Most of us will know now of what we call public assets, which are things like stocks and shares, or mainly stocks, which are essentially when you invest in companies that trade on an exchange, they've undergone something called an IPO. All that really means is you and I and everybody that wants to invest can actually go and invest in these public companies, as long as we do it through a platform or a broker, right? Before these companies became public, they would have had to fulfill certain things. They would have had to have a certain amount of revenue in terms of size as well, and all these things before they would have become a public company. So that's what a public company is. We know most of them, Coca-Cola, McDonald's, Apple, Microsoft, Amazon. These are all public companies. Private companies are essentially companies. They are companies as well, so they're corporate organizations, but they do not float on an exchange. And what that means is you can't just go and buy shares in these companies on an exchange. So if Peter started a company this week and called it Peter Ltd, or Peter Consulting Ltd, that would be a consultancy, that would be a limited company. Notice that I put Ltd at the end. Also, if you want to notice what a public company is, as well, they normally have PLC at the end as well. Now, with Peter Limited, it is a private company. No one can just go and decide that they want to invest in a company and go and buy shares on a secondary exchange. That can't happen. Of course, if I wanted to go and invest directly in your business, Peter, using this as an example, I will have to come and speak to you directly. That is called a private asset. It's an asset that is privately owned and not publicly owned.
I love that. I love that. I love that. And I guess it'll be interesting to understand. You've distinguished between, public trading companies that me and you and the everyday individual can put our money into, but obviously these private assets are privately owned, as you've explained. Why, I mean, given that there are these public companies, you mentioned Apple, you mentioned Coca-Cola and loads of other companies, why should I even bother to think about private assets? Why should I even, yeah, consider private assets?
Yeah. So private assets is another asset class. You know, I talk about asset classes all the time. And it is a type of equity, but as we notice now, it's not a public equity, which means it comes with certain characteristics that investors, often institutional investors, but today we're talking about retail investors, but institutional investors find these assets attractive for two main reasons. One, because it can provide better returns, higher returns. And two, they provide what we call diversification benefits, which means if you have a portfolio of public equities and bonds, which is quite common, they move in different ways. They respond to market trends in different ways. By adding other asset classes like private equity or private assets, it creates a diversification benefit because that asset behaves differently to the other assets. So those are the two main reasons why people will be very attracted to private assets. One is the diversification element, and two is, of course, the opportunity for much better returns.
Random, can some of these private companies end up becoming public, I'm assuming?
Yeah, well, the truth of the matter is public companies were once private.
Mm,
So,
mm,
yes, most companies that you'll come across, they would have been private companies first. And they would have chosen to be public. And they would choose to be public because they want access to more capital, more investors, right? That's why they're public. Now, what is true is that there is an increase in companies who are staying private for longer. So what that means is essentially companies can decide to go public once they satisfy a few things that I mentioned earlier, right? So what's
mhm.
happening is even though a lot of companies now satisfy those things that, allows them to, be on a stock exchange and become public, they are actually choosing not to. And one of the main reasons behind that is because once you go public, you are now subject to many, many different rules and regulations.
Mm,
So, for example, public companies are required by certain standards to report on a quarterly basis, for example, right? You have to give certain amounts of information. You have to make your information public, right? Your shareholders are also public, and essentially you don't have control over who your shareholders actually are. Okay, so for that reason, a lot of companies nowadays, especially, are choosing to stay private for longer.
no, I can imagine. And I can imagine also for those that invest in private companies, should that company in, I don't know, a X amount of years become public, I'm assuming there will be benefits for those that got into these companies quite earlier on.
Yes, huge benefits. So it is common that most people may have been even private asset investors without even knowing. They may not have actively made a decision to be a private investor, but they could have worked for like a startup or an early stage company. And one of the benefits that they would have got is options, right? They would have owned options or owned shares, sorry, in the business. And so what happens is when the company goes public, so it goes through the IPO process, there's a price that is normally set. They work with investment banks, and often that price will be quite attractive for those people that actually were owners of the business whilst it was still private.
Hmm. So maybe those people that work for these companies and you've got shares in these companies simply by just being an employee, maybe one to take note of.
Yeah, though there's many stories of I think the most popular one or most recent one would have been people who owned shares in, let's say, Nvidia.
Mm.
And they just worked for Nvidia and they had shares and that was part of their compensation, We all know what Nvidia share price has done over the past well, maybe a few years, probably a few months, really. It has been a fantastic investment. And that's even public. So imagine private. The jump is usually much bigger once you go from private to public.
Hmm. No, absolutely. I can imagine. And yes, Nvidia, I believe, don't quote me, they're the first company to hit 4 trillion market cap very recently. But yeah, either way, they are doing extremely well. As a company, let alone, the stock price and all of that jazz. Cool. Okay, Jax, I mean, you mentioned a few of the benefits as to why people might want to invest in them as an alternative asset class as part of a well diversified or portfolio, of course. Now, I guess for a lot of people, Jax, this will be the first time people are hearing about private assets in terms of actually owning part of a private asset or investing in them. So my question to you is, can the everyday individual actually invest in private assets?
Yeah, there are many different ways you can have access to private assets. There is a preferred way I would suggest. But what I would say is it depends on how you want to gain exposure to private assets because not all private assets are the same. So one is, of course, literally becoming what we call an angel investor, which is essentially literally investing in a company at the very early stages of its growth, or probably the growth isn't even the right word. It could be even at the idea stage, right? Where you've got an idea and you're looking for some sort of investors to go along with you. These are angel investors. This is extremely risky, as there is no proof of concept at this stage. And so I would suggest that most retail investors probably do not want to start their investment journey there, unless they are seasoned angel investors themselves or have some experience doing it. And then there are other ways which are more what we call pooled vehicles, which is essentially, well, I call it pooled vehicles, but essentially you're buying into one asset that has access to a whole bunch of different private assets. And there are different ways of doing this. There's something called investment enterprise schemes. There's venture capital, which is investing in a venture capital company or venture capital trust that invest in different venture capital companies, type of companies. And there is also private equity, which is a somewhat slightly different strategy. But what I would suggest is the best way probably to invest in private equity is to invest in what we call an investment company or an investment trust, which focuses on private equity. So that private equity then goes and invests in different companies on your behalf. So this is an indirect way of getting exposure, but it's a diverse a well diversified way of investing in these private assets.
I love that. I love that. Thanks for clarifying a few things. I think people hear terms like, angel investing and all of that stuff, but we don't really understand what that really means or looks like. So,
Yeah.
no, that's really good.
Yeah, I mean I've just thrown out quite a bit of jargon. I think the key thing for our listeners to understand is all these different types of jargons, what it really presents is that there are different stages in which you can invest in a company before it becomes public, right? And so when you hear these terminologies, chances are the different terminologies just represent a different stage.
Mm.
So an angel investor will be very early stage, whereas someone who is a bit more venture capital or private equity will be at different stage. Private equity is much later, venture capital is a bit earlier. So that's the way to really try and get your head around all the different jargon. Starting off just understanding that it really depends on what stage you are investing in these private companies.
And of course, the level of risk varies greatly between each
Exactly,
stage. Yeah,
exactly. The earlier the stage, the higher the risk, but of course, the higher the potential reward.
of course, of course. Now, I guess my final question for you is, after capturing all of this and understanding a bit more about private assets, I guess, yeah, who should be investing in them? Yes, we know that the everyday individual can invest in them, but who should be investing in them? And before you get onto that, Jax, we're of course going to give a shout out to where we are getting new listeners from in a place that we've not given a shout out to before or in a long time. And this city is called Malmo, which is the third largest city in Sweden.
Fantastic. Fantastic, fantastic. Sweden is a country I've not been to. I have friends that have been there, and I've got extended family that live there. It will be nice to go and visit one day. Welcome to the Woke Finance Podcast. You're here with myself, Jax, and the co-host Peter. And on this podcast, we talk about all things finance and all things finance related. But if you want to know more about what we do, because we do more than podcasting, we do serve in the community, head over to www.wokefinance.co.uk. That's www.wokefinance.co.uk and sign up to our mailing list so you are engaged and you are made aware of all the amazing things that we are doing in the community. Also, if you want to engage with us on social media, we are on Instagram, we are on TikTok, and we are on LinkedIn. That's another way you can engage with us and keep up to date with all the amazing things that we are doing. If you search for Woke Finance, you will be sure to find us. Welcome to the Woke Finance Podcast. I hope you are enjoying the episodes and gaining tons of value.
Come on, come on, come on. A massive shout out to our listeners over there and all over the world. Now, Jack, back to my final question, which is, yeah, who should be investing in private assets?
I think the first thing is really understanding what they are and recalling that private assets are more risky, but they do present an opportunity for higher returns. It is also important to understand some of the characteristics of these types of investments. One of those things being the lack of liquidity. Liquidity is essentially the ability or inability to convert your investment into cash quickly and also for a fair price. And with these assets, there is often a lack of liquidity because there's not really a huge secondary market like the public markets. And so for that reason, you must be someone who is a long-term investor. I submit that the time frame for most private assets probably should be 10 years and an absolute minimum of 5 years. If you don't have these time frames, then in my opinion, you probably do not want to be investing in private assets. The second thing is the fact that these assets do provide diversification benefits. And we should remember that, which means it probably shouldn't make the bulk of your portfolio. When you are constructing what we call your strategic asset allocation, which is how much you're going to put in different asset classes, chances are you do not want to put too much of your allocation into these private assets because of the risks involved. And so, if you are someone who has already built a well diversified portfolio of assets to meet your medium to long term goals, then you can add these type of assets to your portfolio, firstly to diversify it and to maybe add a bit more juice to it to boost potential returns. The strategy that I quite like and somewhat use myself is what we call a core satellite approach, where the core of your portfolio, which is the higher percentage of your portfolio, is invested in a well diversified pool of investments like index funds or mutual funds. And then you can choose a proportion of your portfolio, maybe 10% maximum, to invest in things that could be more exciting or things that you are more interested in. In that 10%, you could choose a percentage to invest in some of these private assets, in my opinion.
Love it, love it, love it, love it, man. For our new listeners and those that have been following us for a while, hopefully that was some useful information and it's given you a bit of food for thought. For any of you that are hearing about these private assets for the first time as well, and you have any questions that are bubbling as a result of listening to this episode, you know all of our platforms. So it's up to you to ask away, ask us, send a question through, and we can definitely get back to you. We can get back to you privately, or we can answer it on a podcast episode, as we've been doing over the last few years as well. Or if you want, you can ask someone in your networks and start up a conversation with them. That's why we do this podcast. We want to encourage the conversation to keep going on. And of course, if you found any value and you just want to say thank you, you can thank us in a number of ways, which Jax mentioned earlier on. You know what to do: subscribe, comment, like, share on your internet socials, all of that stuff, man. But Jax, any final words before I let you go?
I think the key thing is to understand that private assets are an interesting area, an area that I think will grow in importance and grow in terms of people's interest over time. I think is an area that first, before you even begin to start investing in it, you want to spend some time really understanding what it's all about. But if you want to know some platforms that allow you to do very early stage investing, I think here in the UK we've got Crowdcube and Seeders. And then there are other platforms as well. But again, I would be very mindful of the risks associated with these type of investments. You can also look at venture capital, as I said earlier, venture capital and enterprise investment schemes, EIS and VCTs. These also have very attractive tax implications, mostly for people that are of the high net worth nature, but you can definitely look at them as well. So yeah, very interesting areas. Remember, this is a podcast. You have two strangers, or for some of us who has been, some of you guys have been with us for a very long time. We're not strangers to you. You maybe it's important to understand that it is, even though we are providing you with information, it's important that you go back and do your own reading, do your own studying, and do your own confirmation of what we're talking about here before you even consider investing in some of these things.
Hmm. I love that, man. I love that. And there we have it, man. Thank you very much, Jax. Thank you very much for our listeners. And remember, all
Stay
stay woke.